Hi there, I'm here with Ephraim Schwartz, very good friend of mine, but also the lender who helped me purchase my properties and refi my properties here and has helped over 100 of my clients. Thanks for being with us here today, Ephraim.
Brad, thanks for having me.
Absolutely. Ephraim is a wealth of knowledge, so I brought him here to share some information about, from a lender's perspective, what he's seeing in the market. So real quick, just as a little background, why don't you give us, call the last 4 years, how did we get to where we are today?
Yeah, so mortgage rates are based on bond prices. And during COVID, the Fed printed an absurd amount of money, spent it all buying bonds, pushing bond prices up. That brought rates and yields down to an all-time low. And then once they put an end to that bond purchase program, allowed bonds to be determined by normal economic factors, which is inflation. Inflation spiked from, we've seen about 2% for the majority of the last decade and a half. Inflation spiked all the way to 9%. That's what pushed mortgage rates up. And since then, now we've seen inflation really coming back down, and we're just having to be patient to see mortgage rates really respond.
Let's talk about the Fed meeting last week. There was some significant news came from that. Which perspective and summary of that?
So the Fed had been in a rate hiking cycle, which is aimed at curbing inflation. What Fed Chairman Powell says that they're seeing inflation steadily head towards 2%, which is their target, but they're not yet ready to cut rates. So that really quelled any hope that they would be doing the first rate cut in the cycle in March. It's probably going to be May or June. But the good news is inflation's coming down, and that's what we're looking for in terms of what will help mortgage rates improve again.
Feels like we're on a good trend, that's for sure. Here we are on the 9th. Most of you are not going to receive this till next week, so things could change between now and then. Obviously, there's another big meeting. You can talk about that briefly too next week. But let's just talk about where are we today as far as interest rates. Most of our buyers are looking at million plus homes.
Yeah.
They're $1 million plus homes. They're looking at vacation properties.
Yeah.
What can they expect as of today?
So mortgage rates, about late October when the 10-year Treasury yield was about 5%, mortgage rates were flirting with 8%. They've come down almost a full percent, got into the high sixes, and then spiked just a little bit this last week. So today we're looking right around 7, low 7s, maybe spending a point to get into the high sixes. And then the reports that are coming up that you mentioned, CPI inflation data will come out next week. We're hoping for cooler inflation. And the metric that I'm watching is that 10-year Treasury yield. 4% is a really significant benchmark. That 10-year Treasury yield, we really want to see that get back below 4%, and that's kind of a ceiling of resistance.
Fingers crossed.
Yeah.
Absolutely. Super helpful. We've talked a lot about this. I know you're experiencing it from your perspective, but us as realtors, one of the things we're dealing with is a lot of buyers are still engaged, asking a lot of questions, they're reading our emails, they're looking at properties, but they're just not pulling the trigger. And so in summary, a lot of people are sitting on the fence and the explanation has been, I'm waiting for rates to come down.
Yeah.
What have you heard? What substantiates that from your perspective?
We've seen that as well, and I read an AP poll a couple of months ago that 39% of polled buyers said they were waiting for rates to come down. And so when we think about just the balance of supply and demand in the market, a lot of buyers have had that mentality. Rates have begun to come back down. They're not as low as we like them to see, and we do think they'll continue to come back down, come down further, I should say. And to put that into context, at the beginning of 2023, the Mortgage Bankers Association of America estimated that the average 30-year fixed at the end of 2023 would be 5.3%. That was obviously way off. But what's important to point out is the data they were looking at, the inflation data and the things that affect bond prices, that is all still there and was a reasonable projection. It's just taking longer for everything to get there. So I do think that as we look at where rates will be in the next year or two, 30-year fixes coming back down to the low sixes and then into the fives is most likely what we'll see, and that's a good, normal, healthy place for them to be. And as we have seen 30-year fixes come from 8% down into the low sevens, high sixes, we have seen some folks who are looking to be opportunistic and contrarian to what most of the market's doing, starting to get back in and thinking opportunistically.
Yeah, absolutely. We've seen an uptick in transactions, pending in transactions in MLS. And so I guess my advice to my buyers is, you're not the only ones waiting for those rates to come down. And when they do, you're going to have a lot more competition. So what's your advice to someone who's looking at it and saying, I don't want to block in these rates now? Is there a strategy to buying now and then maybe refining on the road?
Absolutely. We're having that conversation with every buyer right now. How do we structure the loan and fine tune it based on whether or not you want to assume that you're going to refinance the next year or two? I think most likely rates are going to come down at least a full percent, which is what you want to see to refinance and have it pencil. And so getting into a property in a less competitive environment, a lower purchase price right now, and then just structuring the mortgage in terms of the product and whether or not you pay any points, planning to refinance in the next year or two is a strategy that when you look back on this years from now, is something that I think could work out very well.
Yeah, I think that long haul, you end up paying more on the purchase price.
Yeah,
because the competition is going to drive those prices up. So this is
absolutely, and you may end up only having that higher rate on the mortgage for a year, maybe less,
right.
And then you refinance out of it and drop the rate into a 30-year fixed with something in the fives or low sixes.
Yeah, this has definitely created an opportunity for buyers for sure. But
as Warren Buffett would say, be scared when people are greedy and greedy when people are scared.
It's a great note to end on. Thank you. This has been super insightful. We could have this conversation for another hour or so, but just wanted to give you a quick summary of what he's seeing. If you are looking at refinancing, you're looking to do a loan, Ephraim's a great guy, great resource. And again, like personal experience, he helped me with my own purchases and he's helped a lot of my clients. So his contact information is noted below, but thank you, Ephraim. Really appreciate it. Great to see you and hope to see you on the slopes.
Thanks for having me.
You bet.